So let's take a situation here where there's a person who dies, the taxpayer. Now, this was the initial taxpayer who was entitled to a large salary payment and the date of her death. So there was a big amount that was supposed to her, but then she died before that. The amount was to be paid in 6 annual installments. The taxpayer who is deceased. So we call this person a deceased taxpayer. The deceased taxpayer had earned some salary, but the money did not physically flow to that person before the date of death. The estate, after collecting 2 installments. So now we have another entity. So this was entity 1. We have another entity called the estate. The estate takes 2 installments, distributed the right to the remaining installments to Mary, the daughter. And now we have the third party, and the third party is called the beneficiary. So this is the person who's ultimately going to get the money, and the estate is holding that money only for the intervening period before the transition to the progeny, or before the transition to the beneficiary would have happened. Now we know that whenever we have inheritance, then the estate has to step up or step down to the fair market value on the date of death, or latest 6 months from the date of death, if the executor would have chosen that date, right? So all of those concepts will become applicable here. So the question is, who's going to file what return? The first return is of the decedent, which is the taxpayer who's deceased. Now, ideally, the tax, we don't prorate it, right? We know this right from the first session that we did in part 1, that birth and death are not prorated. So that's a very first thing that we learned in US taxation. So both birth and death are not prorated. We know this. So if these are not prorated, that means that the person dies during the year. Let's say the person dies in the second month. So we are not going to split income in 2 versus 10, and then the income tax return, the decedent would only be filed for 2 months. It's not going to be like that. The income tax return is going to be filed only on the due date, and on the due date, it will be for the money that the decedent has received or had the right to receive. So it depends on what is the tax basis of the decedent. If the decedent is a cash basis taxpayer, then the money that the decedent receives before the date of death becomes important. If the decedent is an accrual basis taxpayer, then the money that the decedent had the right to receive and something that was accrued to the decedent death, that becomes the money which is going to be taxed in the hands of the decedent. So we call this 1040 of the decedent. Now in this case, the salary was not received before the date of death. So ideally, there would be nothing that would be taxed as an income of the deceased. The income with respect to dividend is never taxed in the hands of the deceased. It always is taxed in somebody else's hand. So the money which belongs by the decedent taxpayer, but which the decedent taxpayer could not receive, becomes income with respect to the decedent. The tax and income in the hands of somebody else, as though that somebody else is the decedent. So who is that somebody else? Now that somebody else, when that somebody else will file 1041, that would be called IRD, the income with respect to the decedent. So whoever receives that money would be paying tax on that money. So in this example, for 2 months, the estate received that money. So the estate will fill out form 1041, which would be the income tax return of the estate. So this is the income tax return of the estate. The 2 installments received by the estate taxed the hands of the estate, and the balance 4 installments would be taxed the hands of the beneficiary, where 1041. So we have 3 forms: 1040 of the deceased, 1041 of the estate, and 1040 of the beneficiary. To the extent of the money actually received by either the estate or the beneficiary, which was actually not supposed to be taxed in their hand, but was supposed to be taxed in the hands of the deceased taxpayer.